Welcome back to another coffee chat with Tiaan Herselman, head of Old Mutual Wealth Proposition, where with 4 continents having major elections this year in 2024, our sights turn to offshore or global investing. Why offshore? What does offshore mean? And what are the various ways that clients and planners can take their money offshore? Now, Tiaan, there is a Chinese proverb that says, may you live in interesting times. Although if you look at some of the macro influences on global or offshore investing, it does sometimes feel like a bit of a curse. If you bring it down to the South African context, the latest figures from the South African Reserve Bank show that capital outflows by South African individuals is definitely on the upward trend, in spite of the rand-dollar volatility. And it's no secret that the rand has lost probably half its value over the last 10 years to the dollar. But offshore investing is more than just a currency play. Why would clients and planners take their money offshore?
Absolutely. Now, firstly, I think the Chinese proverb was a bit of a curse since 2020. But yeah, thanks, Dave. I think the first thing when considering any investment is that you should have a long-term time horizon. So if you have an investment time horizon of less than 7 years, don't even consider investing any money offshore. And venturing offshore simply because you believe the rand or the currency will weaken or strengthen is not a prudent investment decision, or even a wise one at that. We've seen this strategy go so wrong for many investors in our country trying to time the currency over the short term. But we do see our clients more and more at Old Mutual Wealth ask us some key questions such as, well, how do I protect my wealth against political instability? If I were a global investor, and more of them are global investors, how much of my wealth should I actually expose to the SA market? And how do I get access to a wider range of investment opportunities, not just in SA, but around the globe? And many people speak about diversification, but we view de-risking your portfolio as a key determinant when it comes to moving funds offshore, particularly when it comes to investing in international markets that aren't available in South Africa, such as alternative energy, pharmaceuticals, artificial intelligence, which we don't normally have access to in our market. Now, investing offshore allows an investor to achieve a great spread across nations, sectors, businesses, asset classes, and even various currencies. Now, even though South African companies are trading at very cheap rates, so the way we normally gauge that is something called the price-earning ratio, which basically tells us that our companies are very cheap to buy at the moment. So much so that their price-earnings ratio is half that of the MSCI World Index. That doesn't change the fact that the number of companies on our local exchange has actually reduced from 370 all the way down to 280 quite recently. And if you contrast that with the New York Stock Exchange, where you have in excess or access to over 2,000 companies, it makes us feel a little bit smaller on a global stage. Now, despite being the largest equity market in the African continent, we make up less than 1% of the global equity market, and we are a very resource-dependent economy. However, that being said, investing offshore does not come without its own set of risk. And the first thing you are exposed to, as we alluded a bit earlier, is currency movements that you should be aware of, and that's why you should probably have a long-term time horizon, or you should have a long-term time horizon when investing offshore. Secondly, offshore investments can also be affected by political instability in the country where some of the stocks might be located, or that could be impacted by political events across the globe. An example of this was the more recent Russia-Ukraine crisis, and we saw the impact of that on specifically oil stocks. And then lastly, there could also be some regulatory risks as well. So an example of this is that in Portugal, their tax residents aren't or can't invest in funds domiciled in Guernsey or the Isle of Man or even Bermuda. But to take it together, for me, the case of offshore investing is not simply trying to time the currency. Will the currency weaken over the long term? We expect it will, talking to the rand. But it is about de-risking your portfolio and getting access to opportunities across the globe where we are quite limited on our local front.
Well, you certainly have substantiated a case for offshore and touched on some of the risks of offshore investing. Now, what are the ways that clients and investment planners can take their money offshore?
So many South Africans actually think that the only way you can go offshore is by putting your money on a plane and basically physically taking your money out of the country. But as a South African tax resident, you are permitted to invest up to 11 million per calendar year directly offshore, either once off or cumulatively. And this compromises of your single discretionary allowance of 1 million plus a foreign allowance of another 10 million rand. But this is not the only way that you can invest offshore as a South African investor. For those clients that do not have a lot of money or that are starting to accumulate wealth, offshore allocation can actually be gotten through investing into what we refer to as feeder funds or ETFs, exchange traded funds. Now, you are basically here indirectly investing into offshore funds, but not physically investing into the foreign currency. Your investment will, however, still benefit from offshore market growth and the potentially weakening rand over the long term. But venturing beyond the local borders can be intimidating, particularly in the first time, which also is the same reason it's quite exciting. There's no limit to where you can put your money to work, and the key thing for your first trip offshore with your money is remembering that you don't have to do everything the first time. So global equity is usually a key starting point, even though we see global bonds are actually offering quite attractive yields at the moment. But the first thing you need to do, Dave, is get your money a job. And there's 3 basic ways of doing this when investing offshore. The first one is a portfolio manager that, in combination with your financial planner, will build a bespoke portfolio for you and then keep you informed. The second option is a global equity fund, which is the same thing, but it's pooled for many investors. Or thirdly, you can go passive and invest into a fund that buys basically everything, giving you a slice of the global market or the global economy. Now, on the asset swap front, I think it's important to note that more recently, some investment providers have reached their offshore limits, meaning that clients are limited with regards to how much they can actually invest offshore via rand-denominated funds, specifically on the living annuity front. And luckily at Old Mutual Wealth, these limits are not applicable to us at this point in time, and our clients could invest up to 100% offshore if and when appropriate, if they decide to do that with their financial planner's guidance. Now, on the asset swap front, so still investing offshore but in a local context, we had 3 key options at Old Mutual Wealth. The first one is for smaller investors, maybe investing R1,000 a month onto our Old Mutual Unit Trust platform. They can gain offshore exposure into one of our award-winning funds, our Old Mutual Global Equity Fund, which delivered a 15% return over the last 10 years. For our Islamic clients, they can gain offshore exposure via our recently launched Global Islamic Equity Feeder Fund, which has been in the top quartile since it was launched last year, and in 2023 even delivered a 37% return for the calendar year. And then for clients that have reached the 1 million mark, on our side, we have access to, or we provide them with access to our DFM solutions. We refer to that as tailored fund portfolios, where they can get a mixture of different asset managers, different funds, and that is wrapped into one model for them at quite a competitive pricing structure. And then for clients with investments of 5 million and above, we can build a bespoke portfolio with them with one of our portfolio managers at private clients that actually looks at the mandate their planner gives them, and they can build a bespoke portfolio for them. And then for those clients who want to send their money completely offshore, put it on a plane and get direct offshore exposure, again, we have 3 options quite similar to the 3 local options. Firstly, we have our DFM models. These are direct offshore DFM models, again referred to as tailored fund portfolios for clients of between 1 to 5 million that want to take it directly offshore. Secondly, we also have a core range of unit trust funds, which we've built in partnership with 91, where we've actually leveraged off of their investment expertise, and we refer to this as the 91 core range of solutions. So you've got directly offshore, you've got our DFM solutions, tailored fund portfolios, our 91 core range. Again, these are for clients between 1 to 5 million. And then again, when you reach the 5 million mark, these are clients we normally find that have bespoke needs, and here we prefer a more personal approach. So we can build a bespoke portfolio with one of our specialist portfolio managers alongside their financial planner, who will then build them a bespoke portfolio, whether they want to have direct stocks, ETFs, bonds, treasuries. They can build a unique portfolio to meet their needs. And that's our view of the offshore landscape locally via asset swap portfolios or our direct offshore solutions.
Now, you mentioned putting your money on a plane and taking it directly offshore. For those clients that want to go directly offshore, we currently have the biggest offshore platform in the country, Old Mutual International. What do you attribute its success to?
I think there are 3 core reasons for the success of the Old Mutual International platform. And the first one is the estate planning benefits. The second one is the breadth of the offering we make available to clients and financial planners. And lastly, the simplified administration and taxation on the platform. Now, if I look at the estate planning front, first and foremost, assets invested in the UK and the US in some cases could attract what we refer to as CITES tax, which is basically an offshore estate duty charge, which could be as high as 40%. Now, this structure on the Old Mutual International platform in the Old Mutual Investment Portfolio Plus actually negates that. Furthermore, there's great continuity created upon the passing of the contract holder as they are nominated beneficiaries, which means that if they retain the funds in the current structure, this avoids any capital gains tax liability and the money never needs to come back to SA. So we're not turning the plane around halfway in the air saying we need to make an abort landing, bring the money back. It can stay offshore and go to your desired destination and stay there for the beneficiaries as well. And then because we have beneficiaries nominated, executors' fees are not levied on the investment, which means you could save anywhere up to 3 to 4% just purely in executors' fees, which could really add up for bigger investments. And then if I put the estate planning on the side, if we just look at the breadth and the comprehensive nature of the offering, apart from the core solutions I mentioned a bit earlier, financial planners and clients have access to such a wide range of investment solutions on this particular platform. We have various custodian partners, protected notes for those clients who want a bit of a downside guarantee. We've seen a lot of success on this front. We have over 250 offshore funds. We have DFM models. We have various custodian partners, and we even have various multi-manager solutions as well. Thus, we really have a solution for every client. However, we do believe our core solutions would satisfy the needs of most clients. And then lastly, the administration of the investment, both whilst clients are alive and upon their unfortunate passing, is significantly simplified within the Old Mutual Investment Portfolio Plus. So there's no need to have an offshore will or apply for prorate. So in other words, you don't have to appoint an offshore executor upon the passing of the contract holder, and all taxes are levied within the investment and paid for on behalf of Old Mutual on behalf of the client at a beneficial rate of 30% for capital gains and interest. And capital gains, this is a very important distinguishment when investing directly offshore into the structure. Capital gains are only levied in hard currency, i.e. in the currency that's invested into and not the rand. So if the rand weakens from 20 rand to 30 rand against the dollar, you are not taxed on that rand weakening if you were to withdraw in the form of a capital gains tax. And I think these are some of the reasons why we've seen the platform had the success it's had and why it's grown to the levels it's grown to in recent, not just years, but also decades.
Such food for thought, and goes to show that you should partner with expertise in this particular environment. Join us again for another Old Mutual Wealth Debrief Exchange.